Good afternoon, everyone. This is Ed Talisse for Chelsea Global Advisors and the CQF Institute. It is Friday afternoon, April 10th, 2015. For this week, we're going to talk about some measures that I look at to determine if the broad equity market and the broad fixed income markets are over or undervalued. Now, I don't think anyone's expecting me to talk about how undervalued either market is, but nonetheless, I think these tools that we're going to talk about work for both under and overvaluation situations. Before I jump into that, the way I'm looking at it is here in the U.S. at least, the first quarter in terms of headline indices in the equity market is basically been a wash, although some sector performance has been divergent. So obviously financials have had a pretty bad quarter, but on the other side of the ledger, healthcare continues to trade very well. Energy had a nice comeback after a very depressed fourth quarter last year, and consumer discretionary seems to be catching a bid here as well. Obviously, Europe and Asia are trading extremely well. Still, again, very difficult for investors that aren't invested in local currency in those markets to make money, given what the dollar is doing. So I thought I would take this opportunity before we really roll on with Q1 earnings to look at these intrinsic value measures. So firstly, if we look at the bond market, a typical way to look at 10-year treasuries or 10-year bonds or 10-year JGBs is what I describe as the Damodaran model, where intrinsic value for the bond market is a combination of real GDP. Here in the U.S., fourth quarter GDP was 2.2%, and on top of that, add inflation expectations, which are roughly 2%. So if you take 2.2, fourth quarter real GDP, add 2% for inflation expectations, you get roughly 420. 10-year yields in the U.S., as you know, are 190. So question is, what's the difference? Why is the intrinsic value more than 200 basis points higher than the actual value? Well, the answer is really that investors are willing to pay a huge insurance premium, and that premium should be looked at similar to buying downside put protection on equity portfolios. And I think the trick to getting this right is not to just look at the magnitude of the difference between intrinsic value and where the market's trading, but actually how that spread has changed over time. So what I like to do when that insurance premium is very wide, like it is now, it's probably a time to step a little way back from the bond markets in the U.S. and put your money elsewhere. However, when that spread contracts, it means the premium value of owning government bond securities is not that great. It may be a good time to get involved in the bond market. If we look at the equity markets, the intrinsic value, going back to Graham and Dodd and all the classic finance literature, would sort of include a cash value of holding securities plus some safety value of getting involved to compensate for a risk. Right now, the cash value of owning U.S. equities is close to 5%. Where does the 5% come from? It's a 2% dividend yield plus a 3% buyback yield. Buybacks have been an ongoing story here in the U.S. and is an obvious way to return money to shareholders. So if you have that cash yield of 5% and you take the required return on an equity investment according to the ERP or the equity risk premium, which here is around 8%, you would think that the S&P should be valued closer to 1,500 than to 2,100. So what's the difference there? Well, similar to the bond market where you're paying for insurance value, downside put protection against what's going on in the equity markets here, with the S&P being way above its intrinsic value, you're really paying for the upside potential of either earnings growth, dividends growth, or multiple expansion. So, and again, I think those two tools, the intrinsic value versus the actual value in both the bond and equity markets, are best looked at on how that basis moves over time instead of the absolute level of the basis. For myself, I use both those tools to trade in and out of the market. Right now, I think the interesting thing is if we talk a little bit about the bond market in some more depth, again, real GDP of 2.2, fourth quarter 2014, inflation expectations at 2%, that's 4.2% versus 190. So not only the insurance premium needs to be taken account for, but it's entirely possible that the market's right and that both real GDP in 2015 and beyond, and inflation expectations are going to contract drastically. And I'll leave you with this thought. Thus far in 2015, Q1 GDP is tracking at about 1%. So it's quite a big drop from what we had seen in 2014. And of course, a lot of that's attributed to the weather here on the East Coast, the port closures on the West Coast, and everything in between. So it's entirely possible that the intrinsic value is going to drift down towards the actual value over time as we get new readings on GDP and we get new readings on inflation expectations. That's it for this week. Thank you very much for tuning in, and please check out my own website, chelseaglobaladvisors.com, and the website for the CQF Institute. Thank you.